Thank you.
And
Yeah,
we're
you got the,
recording right now.
okay, great. Good
Morning,
morning,
Diane.
everyone. Welcome to the New York City Retirement Systems Common Investment Meeting via Zoom for Friday, March 19th, 2021. We're going to start by calling the roll at each board. And let me ask Mr. Patrick Dunn at the Fire Pension Fund to get things rolling this morning. You're on mute, Pat. We can't hear you at least. You're not muted on the screen, but we can't hear you. Cannot hear you. So you know what? We're going to come back to you while you work out that audio issue, and we'll move to police. Who is with us from the Police Pension Fund to call the roll?
Hi, John, it's Kevin. Can you hear me?
Yes, Kevin, we can. Thank you.
Good morning. Representing the PBA,
Joe Alejandro.
Betty Caradaro.
DEA,
Kenny Sparks.
we have Jeff there too.
Kevin, I'll get him.
Okay, SBA,
Anthony Borelli.
CEA,
CEA, Johnny Ramirez, and I have LBA's proxy for Lou Torco.
okay, Commissioner of Finance,
Who's Commissioner of Finance this morning? Okay, I'll be the Commissioner of Finance. John Adler representing Commissioner Sharif Solomon.
okay, representing the mayor,
Jim Monray representing Mayor Bill de Blasio.
Controller,
John Dorsett, designee for Controller Scott Stringer.
and in the room with me is Stephanie Zimberg representing the Police Commissioner. So we have a quorum.
Thank you, Mr. Halloran. Next, let's move to NYSERS. Ms. Winery,
Good morning, Chair, Mayor's Office,
John Adler,
Comptroller's Office,
David Jeter representing Controller Scott Stringer.
Public Advocate's Office, Borough President
excellent.
Brooklyn,
Tanya Cantlow representing Brooklyn Borough President Eric Adams.
Borough President Bronx,
Marika Scott McFadden representing Borough President Ruben Diaz Jr.
Borough President Queens,
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island, International Brotherhood of Teamsters,
Ruben Torres and Lawrence Bosley for President Gregory Floyd.
Transport Workers Union,
Dave Katzman for TWU Local 100 President Tony Utano.
and District Council 37.
Excuse me, Ray Santander for Executive Director Henry Garrido.
We have a quorum.
thank you, Melanie. Next,
John, I didn't hear Manhattan called, but
Oh, it's
Matthew
true.
Washington is
Oh,
here.
sorry.
For Manhattan Borough President Gilbert. No problem.
Sorry, Matthew.
Manhattan, the forgotten borough.
That's usually how it goes.
Thank you, Matthew. Okay, moving on to Teachers Retirement System. Patricia Riley. We can't hear you, Patricia, so you might be on mute. I did see you earlier.
Thank you. John Adler,
I am here.
Thomas Brown,
I'm here. Good morning, Patricia.
good morning. Natalie Green Giles,
I'm here.
David Kazansky,
Present.
Russell Buckley.
Here.
Deborah Penny,
Good morning, I'm here.
good morning. Susanna Vickers,
Good morning, here.
good morning. We have a quorum.
Great. Thank you, Patricia. And then let's
What's
see if, what's that? Oh, is it Leroy? You going to take roll?
I'm here. I have
Okay, great.
volume.
Okay, great. Mr. Dunn, please proceed.
Okay. Good morning, Mr. Adler. For Mayor de Blasio,
Cynthia Collins, designee for Mayor Bill de Blasio.
for Controller Stringer,
Jennifer Konovitz, designee for Controller Scott Stringer.
Commissioner
You're
of
in trouble
Finance
hearing you,
Solomon,
Jennifer. Just FYI.
Bill Dukes for Finance Commissioner Sharif Suleiman.
Okay, and for the UFA, Mr. Andrew Ansbro,
Andrew Ansbro, present.
Robert Eustace,
Virtually present.
Eddie Brown,
Here.
Eric Bischoff,
Present.
Pete DeVita.
John Young with Pete DeVita's proxy.
Okay. For the UFOA, Mr. Jack Kelty,
Here.
Mr. Liam Guilfoyle,
Here.
Mr. Paul Mannix.
Here.
And for Fire Commissioner Daniel Nigro.
Terrell Brown for Commissioner Nigro.
Good morning, we have a quorum.
Thank you, Pat. And for BRRS, Mr. Rich.
Morning, John. We are represented today by Isaac Carmignani, Natalie Green Giles, and Russell Buckley. We do not have a quorum, and we will administer this business at our next Board of Trustees meeting, March 25th.
Great. Thank you, Sandy. Okay, all present and accounted for. So let us move to the quarterly fund performance overview. And I will hand it over to the Bureau of Asset Management. So we're not hearing anything if anybody's talking, Alex or Mike.
Sorry,
Mike,
John, having trouble with my mute button this morning.
Okay,
John, can you hear
we
me?
can hear you now.
Okay,
Mike?
great.
Mike, are you
Yes.
able to see the screen?
I am, Diane, thank you.
Okay.
Can you hear me? Good morning, John. Good morning, trustees.
So
As
Mike,
usual-
Alex had his hand up too. Alex, did you say something before Mike gets started?
Yes, can you hear me?
A little bit softly, but we can hear you.
Yeah, because I was speaking before and it didn't sound like you can hear me.
No. But now we can.
Hear
Go
you,
ahead.
Alex.
You can hear me now?
Yes.
Okay, I was just trying to do the introduction. So you know what, I'll just turn it over to Mike for the market overview, and then I'll be coming in after Mike with performance for the quarter ended December 31st.
Great. Thanks.
Thanks, Alex. So I'm going to divide my time this morning into three sections. A review of the public markets performance in Q4, attach a narrative to that performance. The second part is to discuss some of the risks to markets, particularly risks to the equity markets from rising yields. And the last part of my presentation will be on your actual asset allocation at the end of Q4. Next slide, please. So as usual, this is the usual slide to discuss market performances as it feels like ancient history, but as a reminder, the first three rows are your public equity lines, and the returns there were just spectacular. One takeaway from these returns, for the first time in seems like forever, US equities underperformed both international and emerging equities. And that was both due to the rotation within the equity markets, which we're going to spend some time on this morning, as well as the FX effect. What does that mean? That means the dollar was weaker over the quarter, which boosts our international returns. So we go further down the line, further down the rows, you'll see the long duration government returns were negative for the quarter, as yields in the long end were up about 25 basis points in the quarter, resulting in negative returns there. But both investment grade and high yield, the last two rows were positive as credit spreads tightened more than interest rates rose. So very strong returns there as well. Next slide, please. So what were the key driver of the returns in the Q4? I would characterize two important developments in the quarter were the vaccine announcements in early November. As a reminder, the efficacy rates were in the low to mid 90s on both of those. So the markets quickly pivoted to some kind of reopening as the vaccine rollout gets going. And the second thing I would say was the election outcome. Again, it feels like ancient history, but if we think about Q4, at the time, the two Georgia Senate elections were unknown and were runoffs, and they were to take place on January 5th. And at the time in Q4, the assumption was doubtful that both of those seats would go to the Democrats. So the markets were of the view that we were going to have divided government. And subsequently, even though those seats went to the Democrats, won both of those, the Senate is 50-50. the Democrats lost seats in the House, so they still maintain a majority. So even though it is all Democrat government, it's about as tight as it could possibly get. So again, on public equities, very strong returns, but the returns mask what was going on beneath the hood. So we're going to spend some time on the rotation within the equity markets, which was powerful. And again, in fixed income, rising yields in government securities, but spread tightening. Investment grade tightened 36 basis points in the quarter. High yield tightened over 160 basis points. And within the quarter, both investment grade and high yield reached all-time lows for all-in yields. Next slide, please. So this is the first slide on equity rotation. And what this shows, if you just draw your eye to the growth minus value, the two rows in this chart, the top row is for large cap, the middle row there, growth minus value, is for small cap. And you can see that growth massively underperformed for the quarter. But then if you go to the last column, if you take a longer look at that, you can see still that growth has meaningfully outperformed value over a longer time period, although the rotation in the fourth quarter has been powerful. And then just to help illustrate a few of the sectors that contributed to that, at the bottom part of this chart, we're showing the FANGs, which were up sharply in the quarter, but trailed both financials and energy. Financials benefit from rising interest rates and a steeper yield curve, as that has a direct impact on their profitability. So you can see financials had a very strong return in Q4. And the energy index, which has just massively outperformed on longer time frames, had a strong bounce back in Q4 as energy rebounded. And a handful of energy companies actually made announcements about moving towards helping the transition to a low carbon economy. So that was a contributing factor there as well. Next slide, please. So when we talk about what keeps us up at night and risk to the equity market, we're going to highlight two different risks here. So the US equity market, particularly the growth sector of the equity market, remains historically expensive. We've spent a lot of time on these presentations going through different valuation metrics, so I'm not going to repeat all those, but the GSAM chart, which divides the equity market into those 10 deciles, it remains in the 10th decile, the most expensive decile. And as a reminder, that valuation metric relies primarily on price versus earnings multiples over different time periods and sliced and diced differently. But when you think about equity valuations as compared to the interest rate market, and the most common valuation tool there is the equity risk premium, valuations are more moderate, which brings us into the risks and concerns about risk to higher yield. So I'm going to spend some time going over some different macro risks here. And then during the risk presentation from Dan, he's done some really interesting work with some different inflation scenarios, which tie this all together as well. And while we're on the topic of risk, I just want to give a shout out to Dan and his team who've really done great work all year long while they've been understaffed and still without a chief risk officer. So as to risks of higher yield, the Fed remains extraordinarily accommodative. Rates remain at zero, policy rates at zero, quantitative easing continues. And this is in line with their pivot to average inflation targeting. So they now want inflation higher than the target for some period of time to make up for the misses before. And this is really a big reversal in how the Fed thinks about policy that really existed for almost 4 decades. And Chair Powell reinforced that on Wednesday very, very, very strongly. But what's important to remember is while the Fed is going to be reactive to data, not to their forecast, markets are forward-looking, and markets, the rates markets are in motion, as we've all witnessed, at various points in 2021. The second part of the risk to higher yields is the historical fiscal stimulus. And if we take a step back just for a second, remember the tax cut in 2017, that started the push to higher fiscal stimulus, and it's continued under the Biden administration. There was a $1.9 trillion plan that was just passed on top of the $900 billion plan in January. So we've totaled almost $7 trillion in fiscal stimulus since the pandemic started. And debt to GDP ratios are at the same level they were in World War II. So on top of all this accommodation, the vaccine rollout continues. It's accelerating, and it's leading to what looks to be a really strong economic recovery. Again, the Fed on Wednesday upped their growth forecast from 4.2% to 6.5%, and private forecasts are even higher. So we have all this stimulus coming at the time the economy is about to reopen. Next slide, please. We shared this slide with you previously, but it remains important. That's why I'm showing it again. I draw your attention, or let me explain the graph again for those, just for clarity. Across the horizontal axis is the change in the Fed's balance sheet during the pandemic as compared to previously. So this is quantitative easing, but just expressed in percentage increase of the balance sheet. On the vertical axis shows the change in the fiscal deficit from pre-pandemic to now. And again, you can see the massive increase. If we were to update this chart for the last two fiscal stimulus programs, the US red dot in the middle of the graph would be as high as the World War II dot. It would be up at 20%, and it would be a little bit to the right. So this highlights how the size of the monetary and fiscal stimulus that are going on in the economy. Next slide, please. So as to the economy, the slide on the left, the blue line represents the forecast from Morgan Stanley, and the yellow line represents the trend growth that the economy has been on. So Morgan Stanley's forecast is that the economy will eclipse the level of growth, and maybe it already has, but then importantly, the pace of growth will be eclipsed in Q3. And that's meaningful as all the stimulus still remains in financial markets and benefiting the economy. The slide on the right shows the GDP relative to its pre-recession path. So when it crosses that horizontal line in the middle, that means it's eclipsed its path from pre-recession. So you can see in the dark blue line how well the economy has done during this time period. And I really contrast it to the light blue line, which is the path of the economy after the GFC. And you can see how after the GFC, the GDP struggled to get back to its previous level. And that's in contrast to what's happened here. Next slide, please. So a little bit more on interest rates. The graph on the left shows the 10-year break even. So this is the difference between nominal 10-year notes and inflation protected notes. And what's important here is you can see the level is about 230 basis points. So the market is expecting an acceleration in inflation. And importantly, it's above any place it's been prior to post the GFC. So markets are expecting a move higher in inflation. The graph on the right just simply shows some changes in yield for various points on the yield curve, broken out into the second quarter, to 2020, what happened in the fourth quarter, and then importantly, what's happened since then. And then since we marked it, the yields are even higher from that standpoint. Next slide, please. And then more on the equity rotation. So on the left-hand side, this shows on globally the MSCI ACWI All World Value divided by Growth Index in the white line. And as that index goes down, that means value is underperforming growth. The blue line is the 10-year yield. And you can obviously see the relationship that exists here. As yields go down, growth outperforms. As yields go up, growth underperforms. So it's important for the rotation of the equity market, less important for our US equity portfolios as we're mostly indexed. And we benefit from movements in the index. And within the rotation, it's more up to the active managers to capture that. So this is a global chart. So how does this impact our global equity managers? And what you'll see from Alex during his presentation is they've done very well during this time period, but we will note the dispersion between returns on the managers has increased. On the right-hand side, these what we call style boxes come from our risk group, the BAM risk ribbon. So shout out to Chris for this. So this captures the Russell 3000, all 3,000 stocks in it. Across the horizontal axis, the stocks are divided into value, core, or growth stocks. And on the vertical axis, it shows by market cap, large, mid, and small. Top table shows the last 6 months. The bottom table shows the last 3 years. And what you can see in the last 6 months is value has outperformed by all market capitalizations. But again, over the 3-year, that's trailing. Next graph, please. One more look at the equity rotation. So both graphs here show different sectors as compared to the S&P. So not absolute returns, but these sector returns as compared to the S&P. So on the left-hand side, the key takeaway here is the blue line, which shows labeled here the antitrust basket. So Apple, Amazon, Facebook, and Google, and you can just see the massive outperformance. And these stocks do face a potential antitrust risk going forward, so that's a source of concern. On the right-hand side, again, a few different sectors, same way measured against the S&P. So the two takeaways from here, the light blue line shows the Russell 2000, so small caps as compared to the S&P, and you can see some underperformance and then outperformance over the past quarter. And that dark purple line is the energy sector. Again, meaningful underperformance over the past 5 years as the price of oil has declined, as well as markets are recognizing the world is going to transition to a low carbon economy. And then the key question for this sector, are these stocks going to be a casualty of that transition, or are they going to be part of the solution? Yet to be determined. So before I go into asset allocation, let me just pause here for any comments or questions, please.
Okay, if you have a question, use the raise hand button on the participants tab, because I cannot see everybody on the Zoom screen. So any questions, hit the raise hand button on the participant tab.
Excuse me, Mike, I do want to point out that you're running out of time. It's almost time to wrap it up. So if we could keep this quick, that would be great.
Thank you,
Thank you for that
Diane.
reminder, Diane.
Yeah. Larry Bosley has a question. You're on mute, Larry.
Yeah, it's a quick question. So Mike, going back to what you were talking about, are markets bullish on the Build Back Better succeeding despite what appears to be Republican intransigence and obstructionism? Do they believe that the Democrats are going to find 10 more votes and get, say, an infrastructure program through? Is that why the market is excited?
I think the markets are excited by the aggregate amount of fiscal stimulus as well as the accommodative Fed. What I think to the Build Back Better plan, which is in formation now, I believe what the interest rate market is focused on, will that be all deficit spending, or will that be offset by various tax cuts? And I think what we've heard from President Biden during the campaign and continued is he does believe that we do need some changes to the tax code, particularly to individuals making above the threshold, as well as corporate tax cuts, corporate tax hikes. And I think that will offset much, if not all of that. And my 2 cents, Larry, would be if this is increased deficit spending, it's going to put more pressure on higher interest rates. And at some point, we talked about the rotation within equities. At some point, higher interest rates are going to hurt the entire equity market. What that level is, obviously, we don't know. So that to me is a very, very important component of that, how that plan is done. As to the politics of whether they do this, with Republican help or not, your guess is as good as mine. I think we all are in agreement that our infrastructure in the country needs dramatic improvement. So fingers crossed that this gets done, but gets done in a fiscally responsible way.
Thank you.
And there's a question from the UFOA. Got to unmute. Yep, there you go.
Morning, this is Jack Kelpie, UFOA. Just a general question over timing, sequencing. You can go online and get a lot of stuff pretty much real time. Is there any way to speed up? I mean, this is the fourth quarter of last year, 3 months out of date. Moving forward, how do we speed up the overview of where we're at? I mean, from look back, it takes months and months to get look back. Going forward, we take a year or more to get things done. There's got to be something with sequencing in today's dramatic market. I think this is just way too big of a lag to be efficient way to operate. I don't know the mechanics of that. Be willing to work with anybody, however way we can fix it, but this is a little bit too slow, I think.
Jack, I share your frustration. I have morphed my presentation over the years to minimize the Q4 look back and to spend more time on forward-looking concerns. And you know, the bulk of my time this morning has been on forward-looking returns, and I've tried to update those, you know, as of March 10th. I don't know if you're speaking specifically about this or different processes within BAM, but those are obviously, you know, much broader conversations.
Just some of the people in the field that we've talked to, I mean, they got real-time results on the screen, just boom, tell it up, and they'll know exactly where their money is at, you know, close of business day. It takes us months to find out remotely, like, and get a picture of where we're at. I know software exists that keeps a real-time track of where your investments might be. I don't know how we move this forward, but where the speed at which we operate and the world in which we are operating in are two different timescales by, I'd say, exponentially margin separation.
If it gives you any comfort, the risk ribbon which I referenced is real time. It's not real time. It's lagged by 1 day, and the rebalancing committee, which you know, which is charged with moving money around within your rebalancing ranges to keep you on your targets, operates, you know, with a 1 day lag, and we meet multiple times a week, as you're aware, and so we are operating that way. I hope that gives you comfort. You know, as a reminder, we're, you know, a long-term pension fund with long-term aspirations, and we try not to get, we do not try and time the market. We do not try and think that we know more than the market, and we stick to our long-term targets within doing that. But we do have real-time information that we operate with.
That makes me very happy. It's just within Convene or some other software update, there ought to be a way for the trustees to better monitor what's going on, that we have a clearer idea rather than months. The only real look back we get is months in the rearview mirror. Going forward, I would like to see if we can get more up-to-date information. That's I know it's a long-term process, but I just think all 5 funds are better served if the trustees has a more precise and current idea of where we stand.
That's assured.
Okay, there's also a question from Officer Alejandro. Unmute yourself, Joe.
I
do
am
want to point out that
I'm unmuted. Yeah.
Okay, go ahead.
Mike, just to chime in with that, and it's I brought this up a while back when Scott Evans was the CIO, and I got some answer, and at the time, I think it was over 2 years ago, almost 3 years ago when I brought this up. There are trustees in this country in real time getting their information. And at the time, I was told the information needed to be scrubbed, which did not make me happy at that time either. All right. I think it's well beyond the time that trustees have access to information, if not in real time, close to real time. And that's a problem. And I think we have given BAM and I think an extraordinary amount of money to have systems, computer systems. If they haven't gotten it done, I don't know what's going to get it done, but I think we need to have this information a lot better than 3 months later. Like I said, there are trustees in this city right now, okay, sitting on funds where they have access to their information, if not in real time, very close to real time.
Okay, so look, I mean,
Well,
I
I'd like
share
an answer.
this.
No, John, I'd like.
This is what
BAM
I'm going to
address that.
suggest, Joe. I'm going to suggest we put this on the agenda for the next SIM, is how we can speed up, how BAM can speed up their reporting to trustees, because I hear the demand, but it's not on the agenda for today, and we do have a very long agenda for today. And so my suggestion is that we put it on the agenda for the next SIM to discuss what are the options for BAM to provide trustees with more up-to-date, real-time or almost real-time reporting? Okay,
Sounds good.
thank you. Thank you, Joe. Okay, Mike, do you have more? Because we are out of time for your presentation.
Yeah, I'll run through the asset allocation. It's really quick.
Thank
Next
you.
slide, please. This is a summary of rebalancing activities that we did on behalf of the 5 systems in Q4. Takeaway can be summed in the bottom, the totals in the bottom. We sold about $2.8 billion worth of the various public equity markets and allocated those to various parts of the fixed income market. And that was all driven by market performance in the Q4. So as equity markets rose, to stay at your strategic asset allocation targets, we reduced the equities by a little bit. Next slide, please. The bubble charts, again, a reminder, this is a snapshot at the end of Q4 of where each of your portfolios stood relative to your asset allocation targets. And the takeaways here are pretty straightforward. On the left side of this graph, these are the 3 different public equity lines, all slightly overweight as the markets continue to run. Next slide, please. In terms of your inflation protection securities at or near your asset allocation targets, not much a story here. Next slide, please. Where were we underweight? We were underweight various points of the fixed income market. So we were slightly underweight treasuries, slightly underweight mortgages, slightly underweight credit. And these are all the offsets to the slightly overweight equity market. Next slide, please. So what's important with your core fixed income target, your core fixed income portfolios is your duration target. Row 2 here shows the new asset allocation targets. The bottom row shows where the duration of these portfolios were at the end of the quarter, and you can see at or near all of your targets. That concludes the asset allocation review. So any questions there, or we will hand it over to Mr. Dunya.
Any further questions for Mr. Haddad? Great. Okay, Alex, it's yours.
Good morning. Can you hear me?
Yes.
Excellent. Well, first of all, good morning, everyone. And just to the comments and questions on in the last presentation, we will certainly look into the ability to speed up reporting as is being asked, maybe tied to what we deliver on a monthly basis once the numbers have been cleared from State Street. But we will dig into that to see what we can do to expedite the dissemination of performance. So let me turn to fourth quarter performance, and having heard you, I will go very quickly through the fourth quarter. Next slide. So here on this page, we have plan assets for the systems in the aggregate through December 31st of 2020. And the system's aggregate assets stood at about $247 billion. Next slide, please. So here's fund performance for the quarter, fiscal year to date period, and trailing 1, 2, and 3, 1, 3, and 5 years, excuse me. One thing I'll point you to is that second column from the left, where we show standard deviation for the trailing 1 year by systems. And you will see and notice that NYSERS has the highest portfolio standard deviation in the trailing 1 year period, which is actually a change from prior quarters where BRRRR was highest. Now that increase in volatility is primarily attributable to a manager's exposure to cyclical stocks in NYSERS EAFE portfolio. It's important to note that this exposure has also contributed to that manager's very strong outperformance in the quarter. Turning to the quarter, the system's returns range anywhere from 9.67% for FIRE to 10.37% for BRRRR. The systems posted very strong returns in the fourth quarter as global equity markets continued to rally. The systems had in the quarter a bit of a mixed performance versus the index portfolio. And just you can see from that third column from the left, the system's outperformance in emerging markets was actually a little bit partially offset by private markets underperformance, versus the equity portion of the index portfolio. For NICERS, I will mention that the emerging markets portfolio had a blowout quarter, delivering in excess of 25% in absolute returns. Now, given the strong equity rally, the systems exceeded clearly the 7% assumed weighted return for the last year, and also in the trailing 3 and 5 year periods. In addition, all systems with the exclusion of NICERS for the 1 and 3 year trailing periods have also outperformed a 65-35 index portfolio, and all systems outperformed other large pension plans as measured by TUX in all periods. Next slide, please. Here we have total performance for each system for the quarter versus each system's custom benchmark. All systems slightly outperformed versus their custom benchmarks in the quarter, as you can see from the bar chart on the far right-hand side. The horizontal line, once again, represents the 7% assumed rate of return for the quarter, and all systems significantly exceeded the assumed rate of return. Next slide. So when you break down the components contributing to the outperformance for all systems, you'll notice that it's primarily due to manager value add. The system's managers generally outperform the benchmarks in public equities and fixed income, with some minor exceptions, and also outperformed in private equities, OFI, and infrastructure. In the following slides, I will highlight performance by asset class. Next slide. So beginning with US equities, here we show US performance versus the benchmark. All systems outperformed their respective benchmarks in the quarter, with the exception of teachers, which is slightly underperformed. Again, as you heard from Mike, it was a strong quarter in US equities, led by positive news on the COVID-19 vaccine front. And the story in US equities was the rotation to value stocks, as value outperformed growth in the quarter. In addition, I'll mention that for NICERS, police and fire, outperformance was driven by research affiliates and scientific beta. And these are managers that benefited from the rotation to value over growth in the quarter. However, as you know, those managers are also responsible for the 3 systems' underperformance in the trailing 3 year period. Now for teachers, the slight underperformance was driven by small cap active managers. And for BRRRR, the outperformance was driven by its mid cap active manager. Next slide. So here we have the EFI portfolio. Non-US developed equity markets continued to perform strongly in the 4th quarter, outperforming US markets, and continued dollar weakness was a positive and helped to drive returns in US dollars. Next slide. So here we show emerging markets. So although performance was mixed across the systems versus each system's custom benchmark, overall performance was quite strong, as emerging markets outperformed all global equity markets. Now for teachers, police, and fires managers outperformed their respective benchmarks, while NICERS and BRRRR managers underperformed. For NICERS, I will note that BAM began transitioning away from the custom benchmark in Q4, and all managers should be transitioned to the standard index by the end of this current quarter. So there is some noise in the quarter's performance for NICERS versus the benchmark. Next slide. So turning to the public fixed income portfolio, overall returns in the quarter were generally flat versus the benchmark, with BRRRR just slightly outperforming. Fixed income markets, as you heard from Mike, generated positive returns overall, with the Barclays Agg up about 67 basis points in the quarter as credit spreads tightened. In treasuries, yields widened by about, for the 10-year, by about 24 basis points, finishing at 91 basis points for the year. So the government's portfolio returns were down in the quarter. Mortgages did well in the quarter as spreads tightened, and investment grade credit was a strong performer in the quarter, outperforming treasuries and mortgages as spreads tightened more than yields rose. Now let's turn to the next slide. High yield. So high yield returns continue their strong rebound in the quarter, with the index returning 6.5%, despite the slightly underperformance versus the high yield benchmark, the high yield portfolio delivered strong absolute returns in the quarter. Next slide. Hedge funds. So hedge funds for police and fire. The hedge funds portfolio underperformed this benchmark in Q4 and the fiscal year to date periods as the equity markets rallied. However, I wanted to note that for calendar year 2020, which is not on this slide, the portfolio delivered its best calendar year results, returning over 17% in 2020. Now let's move to private markets. Next slide. Next slide. Beginning with OFI. So for the OFI portfolio through Q4, the portfolio is trailing the benchmark since inception, which is the public market equivalent, or PME, plus a 300 basis points illiquidity premium. In Q4, the portfolio had an estimated net return of 5.8%, outperforming the custom blended PME benchmark, which returned 5.1% in the quarter. Now, gains in the OFI portfolio for the quarter were driven by managers with broad credit mandates, where those managers were able to be flexible and opportunistic and take advantage of market trends that favor distress, some of the riskier segments of the market, and COVID impacted sectors. Next slide, please. For private equity, we have performance through the third quarter, as performance is reported on a lag. Since inception, returns for all systems range from 10.1% for NYSERS to 12.4% for BRRRRs. As you can see on this chart, all systems in NYSERS were either flat or exceeded the public market equivalent since inception. However, the systems continue to lag the PME benchmark. Now, overall, performance improved by about 56 basis points in absolute returns quarter over quarter, so in the third quarter over second, while the PME increased by only 51%. So as a result, the portfolio's PME spread increased about 5 basis points from Q2 to Q3. I will also note that the PE portfolio's valuation has continued to strongly recover throughout 2020. So after being down, as you'll recall, about 9.5% in Q1, it was up 9.8% in Q2 and up another 10.3% in Q3. Next slide, core real estate. So here we have core real estate. Looking at third quarter since inception performance, core real estate investments underperformed the PME benchmark for all systems with the exception of BRRRRs. That was flat. Core real estate valuations were again written down in Q3, and that was driven by continued weakness in hospitality and retail. The portfolio's underperformance versus the PME widened in the quarter as the markets rallied while the portfolio was marked down in the third quarter. Next slide, please. Non-core real estate. So looking at non-core real estate for the third quarter, since inception performance, the non-core portfolio outperformed the PME benchmark for all systems with the exception of fire. In addition, the non-core portfolio actually was slightly marked up in the quarter over the second quarter by about 10 basis points. And this is actually the first valuation markup since the beginning of the COVID-driven valuation markdown in the real estate portfolio. It certainly appears that we may have hit a trough in the non-core portfolio's valuation, and we may begin to see quarter over quarter valuation increases as the economy reopens. And last slide here. Thank you. Infrastructure. So infrastructure for Q3, the portfolio is about 51% funded. It's diversified across 173 portfolio companies that are primarily located in North America. So half of the portfolio is North America, 30% Europe. And from a sector perspective, it has exposure to renewables at 23%, transportation at 21%. Performance, again, in infra continues to be very strong with Q3 since inception returns of 11% net across systems, and all systems continue to outperform their benchmark. And with that, I'll turn it to any questions.
Okay, questions, hit the raise hand button on the participants tab if you have questions for Alex on the performance. And if there are, I think, questions about system-specific performance, I believe Alex will make himself available during the caucuses for those questions. Okay, I don't see any. So we're going to move on to the risk update. And I believe that's Dan Haas.
Yeah, good morning, everyone. Can you hear me okay?
Yeah, we can hear you good, Dan.
Fabulous. Well, thanks, John, and good morning, everyone. Today, as before, we'll just spend a few minutes just going over the highlights from your quarterly risk reports that were posted and convened for December. And then we'll move on to those inflation scenarios that Mike talked earlier.
Folks, if you can mute if you're not speaking, so everybody should be on mute now except for Dan. Thanks.
Okay, so again, here's always a familiar slide to everybody, the risk summary report that appears on your quarterly reports. Looking at the top left panel, you note that the total planned risk was for the quarter was 14.56%, down very slightly 14 basis points from the 14.7% you saw in September. The benchmark risk also had a corresponding decline. That's at 13.25%, down from 13.77% back in September. Table and chart off to the right there. Again, that's just giving you a sense of where the portfolio is picking up its risk on a contributory basis. You'll note that while we're about 2/3 or 69%, I guess, weighted to equity, we derive a little more than 90% of our risk from those equity asset classes. Chart on the right there, just a graphical representation of the table that you see in the middle. Moving down to the bottom, we plotted the 1-year trailing portfolio risk. It's the blue line. The benchmark risk, the red line, and then of course the beta, which are the gray bars. It's month over month for the year ended in December 2020. As a reminder, this is a monthly plot of our forecasted risk based on MSCI's long-term models. Of course, as before, the risk jumped in April in response to the market events in February and March for COVID crisis, and have remained at that level more or less ever since. Another theme that we're noticing, again, a very slight dispersion between the benchmark risk and the portfolio risk over the course of the quarter, where, of course, the benchmark fell a little bit more than the portfolio. Moving on to the next slide. Again, this is a kind of a high-level decomposition of how risk, that 14 basis point change actually occurred in the portfolio. Slightly look under the hood anyway. We're dividing it here into 3 broad categories. There's the change in volatility, the change in correlations. Those two you see corresponding to the blue bars there, or the blue arrows there, are market-driven phenomena. I mean, these risks declined in step with market risks and weren't the result of specific position weights or tilts in the portfolio. If you look at the second line on the table, we see that the reduction in market volatility accounted for a 52 basis point reduction in risk. A big chunk of this was driven, if you decompose that a little bit more, by industry factors, and that was led by consumer cyclicals like specialty retail and restaurants. And then we also saw some reduction from IT industries like software and semiconductors. Moving to the middle line there, that 7 basis point reduction of risk attributed to correlations. Again, that just kind of continues a trend we observed last quarter, where the correlations were relaxed a bit and it offered a little bit of a diversification benefit. And then finally, on that third line there, the portfolio, the portion of the portfolio risk that was detached from market trends, it's labeled the change in portfolio exposures. Here, risk actually went up a little bit by 45 basis points. This was driven by industry exposures, where we saw the largest changes from IT sectors, specifically consumer electronics and semiconductors. We also saw contributions from financials and automobiles and components. All in all, we see similar trends now to what we observed last quarter. Market volatility and correlations continued to decline, and those declines were offset somewhat by our exposures. Next slide, please. Great. Returning to the content from your quarterly packages, here we're showing you the factor risk decomposition. Investment factors, you may recall, represent investment exposures that cut across our traditional asset classes. And we've got two main takeaways here. First, it's good to know which of these factors are contributing to the overall risk in active portfolio risk. You can delve into that in more detail by reviewing the table at the top left, where we're examining our exposures to MSCI's macro factor. The second takeaway is that these factor risks cut across our traditional asset classes. You can see that kind of demonstrated. Sorry. You can see that demonstrated in the graph on the bottom where we plot our factor exposure among our broad equity and fixed income allocations. As before, the overall portfolio risk is dominated by our equity factor, which you can see is the light blue shaded line there. But you notice that the equity exposure appears in both our equity and fixed income portfolios. Similarly, we see a bit of fixed income factor exposure in equity portfolios, and just kind of demonstrating that point a bit more. That kind of highlights the highlights of the quarterly reports. If you have any questions before we move along, happy to address them.
Any questions at this time for Dan? UFOA, there's a question.
Jack Kelty again. Going back to that graph you had about our risk compared to the benchmark risk. I noticed it popped up reasonably so after March, after the market downturn. But we were consistently just higher than the benchmark risk, so we are taking on more risk. Is that in any way attributable to trying to reach the 7% assumption rate? Or if not, why are we pulling more risk than what the benchmark standard would be?
Understood. We are pulling our portfolio beta, our exposure to the market is consistently a little bit above 1. Which means that I think we take a little bit more risk within the portfolios. You contribute that to our allocations to alternatives, or you can contribute it to perhaps our active allocations or active manager allocations. I mean, it's consistent, more or less over the long run. So it's not something we really became too concerned about, but if to the extent that you'd like to kind of decompose it and give you a breakdown, we're happy to follow up with that information.
Yes, I would like to follow up on it because, as you know, we're in the middle of discussion about trying to change the assumption rate. And part of the reason for that is the increased risk we would have to take on to reach 7%. So I'd like to know exactly how that impacts our investments. So any more information you can get to us, I'd be really appreciative. Thank you.
Certainly, yeah, we'll give you a breakdown of your active risk where we're picking it up, class by class, and that'll help kind of help us continue the conversation.
Okay, thank you.
Certainly.
Okay, I don't see any other questions. So Dan, do you want to proceed?
You got it. Next slide, please. We can even jump to one more. Okay. We've been doing some work with Mike and Robert on reviewing the core fixed income allocations, and it's a theme that Mike hit on a little bit earlier, where we're seeing break-even inflation rates kind of rising throughout the post-COVID recovery, and we notice that they've recently outpaced, of course, the nominal growth and the real growth of Treasury rates. That suggests that, of course, markets are pricing in higher levels of inflation. Again, echoing a theme that Mike shared with you a little bit earlier. The big question is what it means for our portfolios. A few weeks ago, MSCI published 4 shock scenarios that provide us with kind of a useful framework to examine. And this slide shows you a summary of those 4 stress scenarios. Specifically, they break down into a reflation scenario, overheated economy, stagflation, and disinflation scenarios. These were derived, of course, from macroeconomics models that MSCI used at the end of February. We exposed our February portfolios to those. So this is a little bit more recent market positioning. We wanted to make sure we line those up. And then just kind of looking at the slide, the definitions at the top of the slide describe the overall economic theme that MSCI was modeling to. And then the table down below gives you the specific inputs prescribed by the research. Just bringing you through the scenarios themselves very quickly, we see that our slightly higher inflation in a reflation scenario, but the stimulus package basically works as designed. In this scenario, the U.S. equity market gains, the U.S. dollar strengthens, rates remain relatively stable, and then credit spreads remain tight or tighten a little further, actually. In an overheated economy, that posits that inflation runs a bit high in the short term, but then moderates. Here, the economy runs too hot and there's some damage to economic growth, which leads to increasing pressure on the Fed to scale back its dovish policy. In this scenario, the US equity market drops, the US dollar weakens, credit spreads widen, and nominal rates jump significantly. Under stagflation, we see some substantially higher inflation over the long term, which negatively impacts economic growth and causes widespread uncertainty among market participants. Here, nominal rates rise across all maturities. US equities fall. Credit spreads widen and the US dollar weakens. Finally, in a disinflation regime, we assume that the stimulus doesn't work. Disinflationary forces emerge and result in increased market uncertainty. In this bleaker scenario, nominal rates drop, the US equity market falls significantly, and credit spreads jump back to the levels of May 2020. Again, the table at the bottom lists those specific shocks that we applied for each scenario. I won't wade through the individual inputs, but I will point out that, of course, we applied the same 5 shocks to each scenario in this framework. You can see those laid out in the leftmost column there. Let's see here. And then we ran, of course, each of these scenarios through a representative system portfolio as of February 29th and outlined the expected P&L on the next slide. Perfect. Here we're showing the predicted returns for each of the 4 scenarios, both for the overall portfolio and for selected strategies within the portfolio. Each scenario is represented by a different colored bar, and the resulting predicted change of value is, of course, plotted along the horizontal axis there. At the total portfolio level, you can see that the results range from about a 9.8% gain under the reflation scenario to a 20.7% loss in the disinflation scenario. The results here are largely driven by our equity classes, which perhaps isn't much of a surprise. One of the 5 shocks shown on the last page was to US equity returns. And given our exposure to equities and the relatively high correlation between the US equities where we placed the shock and the other public and private equity classes in Bar 1, we see that the shock alone would account for much of the gains or losses that you see at the portfolio level. You can notice at the high level, we see losses across pretty much all of the asset classes in an overheated economy in the stagflation scenarios, but they don't aggregate to draw the portfolio down more than the equity-led shock prescribed in the disinflation scenario. Looking at the various strategies, we see that treasuries behave pretty much as we'd expect them to. The values declined when we shocked in higher rates and increased when we assumed lower rates, as did the high yield and OFI sectors. Contrast that with tips, where the impacts were a little more muted than I would have guessed, and there appears to be an interaction effect at work between the treasury shocks and inflation shocks there. In summary, we think there's a pretty interesting tool that helps us visualize performance impact of the portfolios given certain market conditions. And if you're all interested in diving deeper into MSCI's research or how we constructed these tests, I'm happy to take your questions now, or of course we can arrange a follow-up call.
Okay, I see another hand from UFOA. Is that a new hand?
Against the 60.
Guys?
No, sir, I'll take it down.
Okay, no problem. Any other questions on these stress tests for Dan? We are over time on this section. Steve.
Sure. Hey, Dan. So this scenario, the widening equity market change, from which day? The December 31st last year, or from which day the changes? I'm just curious.
Steve, we ran this through the February 28th positions because they lined up broadly. Obviously the shocks that MSCI research kind of prescribed for these scenarios were a little bit more recent. They corresponded to our end of February positions. So it was important that we tried to line those two up. So that's your February 28th portfolio run through those specific shocks.
Great, thanks.
Sure.
Okay, any other questions for Dan Haas? Okay, thank you, Dan.
Thank you.
Alex, am I correct that concludes our public agenda for this morning?
That is correct, John.
Okay, great. So we're now going to entertain motions at each board to exit public session and enter executive session. Let's start with fire. Is there a motion at fire to exit public and enter executive session?
So moved.
Second,
Thank you, Ms. Brown. And thank you. Who is the second? Mr. Bischoff?
Liam Guilfoyle.
Liam Guilfoyle. Thank you. Okay, motion made and seconded. Any discussion? All in favor of the motion at fire to exit public and enter executive session, please unmute yourselves and say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Next, let's go to teachers. Is there a motion at teachers to exit public and enter executive session?
Tom Brown, so moved, John.
Thank you, Mr. Brown. Is there a second?
Second, Deborah Penny.
Thank you, Ms. Penny. Any discussion? All in favor of the motion at teachers to exit public and enter executive session, please unmute yourselves and say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Okay, next, let's go to NICERS. Is there a motion at NICERS to exit public and enter executive session?
So moved, Lawrence
Thank you,
Bosley.
Mr. Bosley. Is there a second?
Second.
Thank you, Ms. Scott McFadden. Any discussion? All in favor of the motion to exit public and enter executive session at NICERS, please unmute yourselves and say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. And at police, is there a motion to exit public and enter executive session?
Motion.
So
to
moved, Johnny
exit.
Ramirez.
There you go.
Okay, we'll
Second,
give,
Alejandro.
Okay, thank you, Mr. Ramirez. Thank you, Mr. Alejandro. Any discussion? All in favor of the motion at police to exit public and enter executive session, please unmute yourselves and say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Okay, we are now in executive session at all the boards where we have a quorum. Can we please turn the cameras off and ask any members of the public or any members of the media to please exit the Zoom?